Most people focus on how much they're saving, but they forget the one thing that can eat up to 30% of their hard-earned money: taxes. If all your money is sitting in one place, you're not just investing, you're gambling on what the government will do with tax rates 20 years from now. To win the long game, you need to understand the three tax buckets. Think of these as different rooms for your money. Each has its own rules, its own perks, and its own traps. First up, we have the taxable bucket. This is your flexibility bucket. It holds things like your brokerage accounts, savings, and CDs. The way it works is simple. You put in money that you've already paid taxes on, the biggest. Pro here is that it's incredibly flexible. There are no contribution limits, no age 59.5 rules, and no penalties if you need the cash for an emergency or a sudden business opportunity. It's your liquid, ready-to-go cash. However, there's a con. You pay taxes as you go. Any dividends or capital gains you earn are taxed every single year, and that can really slow down your growth over time. So the verdict: it's great for liquidity, but it's not the most efficient place for your money to compound over the long term. Next, let's talk about the tax-deferred bucket. Think of this as the save now, pay later bucket. This is where your 401ks and traditional IRAs live. It works by giving you a tax break today. The money goes in before taxes, which lowers your current income tax bill. The major pro is that your money grows faster because you aren't paying taxes on the gains every year. Plus, many employers will match your contributions. That's literally free money you shouldn't leave on the table. But here's the con: you're essentially building a partnership with the IRS when you retire and start taking that money out. It's all taxed as ordinary income. The risk here is pretty clear. If tax rates go up in the future, the sweet deal you got today might not look so good tomorrow. You're betting that tax rates will be lower when you retire. Now for my personal favorite, the tax-free bucket, or what I call the tax-never bucket. This includes accounts like the Roth IRA, the Roth 401k, and even cash value life insurance. With this bucket, you pay the tax up front on the money you put in, but once that money is inside, it's all yours. The growth is tax-free, and most importantly, the withdrawals in retirement are completely tax-free. This is your ultimate hedge against rising taxes. It gives you incredible peace of mind because you know exactly how much spendable income you have, down to the last penny. The downside is that you don't get an immediate tax deduction today, and there are often strict limits on how much you can contribute each year. But for long-term certainty, it's hard to beat. So why does all of this matter? Because tax diversification is just as important as market diversification. You need to spread your money across these three buckets to give yourself options. Think about it. If the market crashes, you want to be able to pull from your taxable bucket so you're not forced to sell your investments at a loss. If tax rates skyrocket in the future, you'll want to lean heavily on your tax-free bucket to keep your income stable. And if you happen to have a low-income year during retirement, that might be the perfect time to strategically tap into your tax-deferred bucket. Having a plan gives you flexibility no matter what happens. Financial success isn't just about the rate of return you get. It's about the rate of return you keep. Having the right tools in each of these buckets gives you the one thing every single retiree wants: control. It's about having the power to decide where your income comes from when you take it and how much tax you pay on it. So take a moment and ask yourself, are your buckets balanced? Let's take a look at your strategy and make sure you aren't leaving your future to chance. Click the link in the description or message me to start a conversation. If you find this video helpful, hit the like button and don't forget to subscribe for more tips. Thanks for watching.